So when I launched this podcast 5 years ago, I think you were one of my first guests. I didn't know a thing about you. You just emailed me saying, I got this trucking site. We're writing about trucking, writing about logistics. And so I brought you on and we talked about how you had launched this futures product. The idea of the launch of futures product that then led to launching a website to drive traffic to the futures product. 5 years later, you are now probably the most audacious media operator in the business. Everyone else is running away from print. You're buying print magazines. Everyone is, thinking about going pure digital. You're like, nah, I want to actually get that paper in my hand. So now we're back here. It's 2026. What the hell have you been up to these past few years and how are things going?
Being audacious isn't necessarily smart at times. Look, I think, so the last couple of years, FreightWaves is often called the Bloomberg of Freight, which is a data product. We happen to have a media product as well. And that's really the connotation from a Bloomberg perspective is really that, is the idea that, media equals data, the media drives top of the funnel. The challenge in freight is that it's been in this, almost 4-year recession. It's the largest downturn in history. And being venture-backed, my venture investors did not want to continue to invest in a media business. So 2 years ago, I purchased the media business and rolled it into a small portfolio of print magazines, at the time called Flying Media Group, that we then turned into something called Firecrown, which is a media roll-up of traditional legacy print. And essentially what we're doing is we've taken this venture-backed world-class digital platform talent and now are putting it throughout this traditional print roll-up business where we're buying print media, traditional magazines, at a relatively low valuation compared to other asset classes, and maybe even paying premiums above print goes for, if there's anyone else buying, and rolling them up into an entity we call Firecrown. And then our goal is to essentially address unit economic problems that exist in these businesses, because typically that's what you see a lot of print, is that there's been a lot of sort of debt in the business. I'm not talking literal debt, although that's true. More of just operational business model debt that goes into these businesses. So you got to fix the unit economics. And then over time, we're digitizing those assets using a lot of the infrastructure we had at FreightWaves. And then we're also looking for content to commerce opportunities, which is using that same audience. So essentially the way we think of it is the acquisitions will finance the audience acquisition, because ultimately that's what you're buying when you're buying a media business. You're buying an audience, regardless of your methodology, whether it's print, podcast, digital. And essentially when we own that audience, then it's like, how do we drive other forms of commerce to it? We've done that at FreightWaves with the data product called Sonar. And so our venture investors, while they didn't necessarily sign up for that journey, have benefited greatly from the value creation of that. We're doing that at Firecrown with our flying aviation finance business. So we help people buy airplanes. We've got some e-commerce products. We've tested it in real estate. And what we find is that it works out because once you own an audience versus renting it, you can do a lot of experimentation. The unit economics are real favorable to you owning other commerce products. And you see this. A lot of people have done this. I haven't invented anything new. We've just taken models that have worked in other vehicles. I think Red Bull is probably the most, to anyone in media understands the story. People outside of it probably don't. But Red Bull, take Coke and Pepsi, two of the most prolific advertisers on the planet, spend hundreds of millions of dollars a year just in branding advertising. You may know the number, but it's, I don't know, do they spend $1 billion in advertising? They might very well sell it,
but that's a lot of money.
A lot of money goes into marketing syrup, right?
Yeah, it's a Super Bowl, every sporting event. It's an obscene amount of money.
Lots of money. Even the beer companies do the same. I mean, most of the majority of the cost of goods sold that it goes to beverages selling. So Red Bull, which is the most infamous example, decided they didn't want to spend a lot of money on third-party advertising. So they created basically sports leagues and these sort of high adventure branding opportunities where, person's jumping out of a space, like a space rocket, at 100,000 feet, or
with the Red
doing
Bull
these
logo
stunt
on
planes,
there.
and Red Bull, and it's all earned media, and they've created a top of the funnel experience. The difference is we're essentially going to advertisers and helping them reach these audiences, and then we're finding our own commerce opportunities where the audience wants an entrenched audience. And so that's the way we think of the business, is by owning the assets of these long-term legacy businesses, we can then find commerce opportunities to sell.
All right, so that's like a table of contents of what we're going to talk about today. So let's sort of start over the last year, because you've tweeted a number of times that 2025 was a bit of a difficult year for the business. Talk to me a little bit about how 2025 played out for you all, how it was different than you might have expected going into the year versus what you walked out of the year looking at.
Yeah, I think, a lot of media observers or people that are sort of outside or in the media business but are sort of observing probably knew this was an inevitability. When you do 20 acquisitions over 3 years, you're going to end up at some point that is going to stop. And anyone who's ever been a founder, and you're a founder, as you go through periods of scale, businesses get harder, not easier, because oftentimes the infrastructure that got you there doesn't work at scale. And I think we had a combination of factors. Number one is, as a business, we didn't have very good systems just to run our own organic business. And then certainly when you add M&A into it, there's a whole systems and process you have to build into that. And so both of those areas were relatively weak for our business. And then combine some of the sort of market development. So we bought a business called Active Interest Media's marine boating business. We had bought Bonnier's boating business 2 years ago, in late 2023. And last year in 24, we owned about a 40% of market share. And the only other company that had any sufficient market share, and they're probably 35%, if you will, was Active Interest in Marine business. So these are the two big marine media businesses. And we thought, hey, and that thing, the Bonnier business had printed money. Like, we were very pleased with the asset. And so we said, let's just double down and let's buy the other company, and this will give us a lot of economies of scale. And the week after we closed that deal, the head of our marine business came, and we do these weekly calls where it's forecasting like any business does. And he told me, hey, we're going to be down 20% next year. And I'm like, and we paid a premium for the business. And I was like, why didn't you tell me this a month ago?
Because he wanted the deal to get done.
Well, maybe, or maybe he didn't. I did for whatever various reasons. Whether he wanted the deal to get done, or whether he just didn't do his homework, or we learned something, I don't know. It's not clear to me what actually happened. We did some. It's not as if we didn't do any market research. We actually did quite a bit of it, but something changed in that period of time. We knew that the boating market was stretched coming out of COVID. We knew the credit situation of consumers was tough, but we also were seeing signs that the market was coming back, and there was a lot of animal spirits with Trump's election and victory in the economy. And we were making a calculation that ultimately in our marine business, which actually AIM had properties that were a little bit more premium from a socioeconomic, like they're more luxury, they're focused on the luxury. We said, hey, this is great. Like, luxury doesn't go away in a downturn. We had some assets that were in boating and fishing, which is sort of the lower end of the market. And we knew those were a little stressed, but the other upper end of the market, we didn't think was a problem. But what we didn't really understand was that there was a lot of noise out there, international. There's a lot of concerns about tariffs that were starting to show up. And anyways, our head of boating comes in and says, we're going to be down next year, 20%. It's like, well, that's a $30 million business for us. That's $6 million. If we're going to lose, 20% of $30 million, that's $6 million. So we spent the month of December working on a plan to cut $6 million. Well, guess what?
This is December 2024. Okay.
Coming in, Donald Trump had just been reelected. We were, so we spent the whole month of December just thinking about how to cut, not thinking, coming up with a plan. But here's where the failure of infrastructure, particularly if you're doing roll-ups or any kind of M&A activity, really hits you, is that while we had a plan, we didn't do a very good job executing that plan.
Right.
In fact, our cost, we had a $6 million cost savings, like $6.2 million by the end of December. We had a plan, and the management team was supposed to go get those savings. And that means cost cuts of people, cut discretionary spending, software, all the things that you would expect to go into it. And our costs continued to increase. And we didn't have good systems to monitor it. Like, here's the other thing that we find out is that when you have all these disparate operating systems and even accounting systems, you don't have real-time data, is that you don't get visibility of your executing. So your people are telling you, my management team is telling me, oh, we're getting these savings. And I could clearly see in the sort of the signaling data that these savings weren't showing up. They kept telling me they're coming. They didn't. In fact, our payroll increased. Payroll was a big piece of it up until May. Even though I was like, I can see in the payroll numbers that we would cut some resources and then we would add people back. I could see throughout the P&L that contributor expenses kept increasing. Mm-hmm. And so it wasn't until really May of this past year of 25 before I said, fine, I'm going to take a much more aggressive approach to this. And I remember I used to do a lot of business with UPS. They were a big customer of me when I was in freight. And they had a saying that if the numbers don't change, the people will. Mm-hmm. Like, this is built into the UPS mantra. And that was pretty much I'm going to take a no prisoners approach. And so I went from being a little bit, we'll call it passive management, delegating through people.
Yeah, you were the CEO kind of managing your portfolio.
Delegating through management to basically saying, I'm going to get more ruthless. And so from May on, and really started to see the effect of this in July, I got very ruthless with every single penny that went out the door. Every expense had to come to me, put real strict in places. I demanded that we start putting systems to track this. The great thing about AI is that you can essentially vibe code a lot of software. So we started implement a lot of sort of vibe coded software to just do monitoring and expense management. And we've cut, we actually have cut, I think we're at 9.2 million of year-over-year expenses. So we went from 6 million. That all took place from July on. So the second half of the year, we've cut $9 million of expenses, and those are real cuts. Like, I can validate to the dollar where those are at. And so we also had to grow up as a business, and so we had to put real systems in place, real processes in place, real rules in place, and we started to then start focusing on consolidating this. So in the marine business, we had bought 2 rival platforms, if you will, with lots of various titles. I think there's something like 18 titles just in that marine business. And so we had to consolidate them into one sales group. And before that, they didn't even have the management team that was leading that group didn't even have a joint call between the two teams. And so this is what you see with a lot of M&A and I see this in media. I've observed other media companies that have done the same thing, where they roll up a lot of media companies and they effectively run them the same way. Mm-hmm. They don't get any of the benefits of scale by doing that, because you're effectively inheriting all of your old businesses' sins, the things that got you the opportunity to buy it to begin with, plus your own problems. It's compounding.
But aren't those deals sort of done for like arbitrage opportunities, where like you buy a small thing and then you roll it up and you can get a higher multiple arbitrage? Isn't that sort of why
there is a multiple arbitrage opportunity that exists, but you also have to get there's also the unit economic side of it. There's also the synergies of people. And when one of the best examples of this in the marine business, this has pretty much existed in all the titles, is that, you have a lot of publishers, and I don't know why this is the case, but it's certainly been the titles that we've bought, where if you own a portfolio of, say, 10 titles in a group, they will have an individual salesperson to every single title. So a customer let's take a company like SiriusXM that's selling airtime to the marine business. They may have 5 or 10 people calling on them. So the selling person, Sell Magazine calls on them. Selling World rep calls on them. Because the salespeople are tied to the brand, not tied to the company. And it actually is a problem for those corporates, the advertisers, because they don't want 5 people calling from the same company, and you don't get any cross sells. And so it was really up until the summer before we had not consolidated. And I think the first joint sales call was like October, when we did a lot of restructuring of that team. And so we're starting to get those synergies. We had a pretty rough first half in terms of sales. So some of it was market driven for sure, but a lot of it was self-induced. Like, we screwed up a lot of stuff. And I think what we've seen is, now that we've reformed, we've gotten rid of a lot of the waste in the business. We've put new systems in place to monitor what we're doing and processes, and I brought new management in. But we've also seen that despite of the fact that I think we're down something like 20 different salespeople across the organization, I got the numbers like 70 or 80 sort of go-to-market people before, and we're down something like 20. We're seeing, our bookings going into this year are up 11% year over year. And so we're seeing, even though we've reduced salespeople, and this is the question, and I remember when we were going through this exercise, okay, we have to cut salespeople, we have to cut cost. One of the big pushbacks was, what if we ruin the revenue? And we actually had this, I brought an outsider who had worked for me in payments. He's background's consulting. The thing that he and I kept talking about is, if we're not really bringing value to the advertisers, to the customers, then we don't deserve to exist. If the only reason that this person's taken out an ad campaign is because of the relationship they've had with this person, one of our salespeople, then we don't really have a product. And we need to know that sooner than later, because
eventually
this
person will leave, and then you're
eventually be out of business, because you're right, because the buyers will leave, and the buyers are becoming much more discerning. And so we said, let's just go ahead and take the risk now. And something I've learned through running multiple businesses through multiple cycles over the last, I've done a lot of startups. I've done cold startups. I've done turnarounds. But the thing that's always consistent in particularly these down cycles is that this rule of, you can't control your revenue, but you can control your cost. Right. And I knew that when we had a problem this year, and this is back from last December, that carried me through this entire thesis, was I have to control my cost. There's no excuse for not controlling cost. And the problem that I had in the first half of the year is that the management team that was around me didn't either buy into that fact or didn't know how to execute. I think they were well intentioned, but without systems to actually monitor these things, they would do a lot of things in spreadsheets, but then something, they would go talk to their people, hey, you need to cut this cost. And they would be told, yes, it's happening, but it never was. And we just need to be much more precise. And so we have fixed that. We have a lot less expense in the business going into this year. But we also are seeing improvements in the business because now we're focusing on things that matter.
So let's talk about the thesis of Firecrown before we start really digging into the individual sort of portfolio. So first it was FreightWaves. That was the venture-backed, content data blend. Then you had the opportunity to buy flying, and that was from Bonnier. You like to fly planes. This was your dream asset. And then you went out and bought a whole bunch of other assets, and now you've got Firecrown. What was your thesis around the portfolio of brands that you bought originally pre-Combat? Because I have some pushback on that and how your thesis might have evolved a little bit when you bought that asset. But let's talk about the first, primarily the aviation and the marine assets.
The aviation asset entirely was just because I wanted to be I'm a pilot, and I wanted to, there's this Flash and Flames, which is a blog that covers he had done this article a couple of years ago, Colin had, where it was basically our magazine's the new vanity asset. And it was Time magazine with Benioff and some of the other sort of cases of people buying magazines, not because they're great businesses, but because there was some vanity aspect to it. And they got trophy assets, essentially. I guess that was the new trophy asset.
Well, as long as it doesn't lose money, you get to be a media guy.
You get to be a media guy.
Everyone hates media until you're in the media, and then you love media.
You get some social proof. Yep. It's a great social currency thing. And so that was the original thesis. I was working on a venture-backed startup, and when you are running an early-stage venture-backed startup, a lot of times your energy, early on you're doing every job, and then eventually you end up firing yourself from those jobs, but you're still raising money. And FreightWaves got to the point where I didn't need to raise money anymore. And this is middle of COVID, and I just got bored. And so I bought flying essentially as a trophy asset. Great. I get to go visit all the manufacturers, and I can call on the CEOs of Gulfstream or Cirrus or whatever. And I can hang out with these really cool people involved in airplanes. I thought that was my thinking. Very little of that actually takes place in my life because it actually has become a job. I bought a job because media businesses are jobs. These are children that need a lot of work. And I should have known that. Of course, as a founder, you're sort of a glutton for you want those dopamine hits from this near-death experiences. So you're drawn to really problematic, I can fix her kind of assets. These are businesses that should never go by as a trophy because they are so broken. And that was the original thesis. And then I started buying a couple more aviation magazines because I was like, okay, this is something I can scale. And as an entrepreneur, you're always thinking about that. And then Bonnier reached out. We had bought Flying, and they had reached out to see if I wanted to buy their marine assets because I think they were looking at raising some capital or something that drove that decision. And this is what changed my thesis from, hey, we can do this in aviation to we can do this in other places. And so we worked out a deal that worked for them. My father had a very successful trucking company that he had just sold. He's under a 5-year non-compete. He had built what became the 5th largest trucking company in the United States, $2.5 billion in sales. And he was sort of flush with cash for the first time in his life. Like, he built a very successful business. But if you've ever dealt with an entrepreneur, they always have cash tied up. They have no liquidity.
Yeah.
These guys are all, even my father, who had built a Fortune 1000 company from 1985 and bootstrapped it, never had any liquidity because he was always investing in something. He suddenly had some liquidity and he was looking for places to invest. And I convinced him that, hey, if you will invest with me, we'll go buy up these media assets. And we could buy them at 3 to 5 times EBITDA. And so this was the thinking was that this was a great financial asset. And that was sort of the opportunity to take his capital that he had suddenly flushed with, and he couldn't invest in trucking because it was in his non-compete, and find something that we could go do together. And my dad was pretty depressed after he sold the business. So this was his life. 30 years building, sort of the titan of his industry, and he was looking for something to do. And so this was a great opportunity for me to work with him, obviously accessing very friendly capital, but also an opportunity to build a business with my dad that could be quite big. And so that was really, really sort of he had time, I had a desire and ambition, I had a thesis, and that was really what drove the diversification.
And the thesis was that these were high quality audiences that were relatively price inelastic when it came to their hobbies.
That's correct. So luxury is price inelastic, a lot of disposable income. And if they're into a hobby and have a sort of a passion project, that they will spend almost anything to support that habit. And so that was the original thesis. We were looking at these assets of saying, we could go buy these for the audiences and then we'll find commerce opportunities. And we found that there are certain industries that have been easier for us to do that, like aviation's easier. It's just a less crowded market. Marine's been more challenging to find those kind of assets or find those sort of commercial opportunities. But we knew that if we owned the audience, there was a lot of opportunity. And that was sort of what drove the thesis, was a combination of those factors.
And then was it late 23 or 24 that you bought Comeback?
So we bought Comeback in 24.
Okay.
And this came about because I had bought, again, the challenge of being an entrepreneur, have capital, which is, this is like if you're an addict, and I think entrepreneurs are dopamine addicts.
Yeah.
Now you have someone enabling you, which is my dad has just sold his business.
You had to go find things to buy.
I had to go find something to do. And I bought something called the Space Store, which was the largest e-commerce store, because the space nerds and the airplane nerds are like, the Venn diagram's quite similar. Aeronautics, right?
So you fly a plane and you've got like a little Jupiter hanging from your dashboard.
Yes, they're like the space nerds and the airplane nerds are the same people. In fact, the new NASA administrator, he's a pilot. He flew fighter jets, went in SpaceX, and now is our NASA administrator. So the space nerds and the aviation nerds have a higher overlap. I'm a space nerd. And so we were looking for a space asset and we came across astronomy. We're like, let's see if we can go buy that. And so we reached out to Comeback and they said, hey, we will sell you the whole portfolio. In fact, we have a banker that is listing this business. And we looked at it and we said, model railroading doesn't really fit into this luxury title, but railroads do fit into the trucking, because we actually, FreightWaves covers the railroads quite extensively. And trains is one of the big media assets that had a very under monetized B2B business. It was mostly consumers that love trains. Why don't we buy this trains asset so that we can move into more B2B coverage of the railroads? That was the thesis. And we said, we can make this work. And what's interesting about Comeback is the subscription renewal, the subscription data. It's consumer, but it has SaaS-like best-in-class prescriptions. You're talking mid-80s, low 90s renewal rates on subscriptions, which is really SaaS-like enterprise SaaS-like qualities. And we said, this is amazing. So we found that met a thesis, which is we could continue to take these audiences and buy things at relatively low valuations, which is true in this case as well. That thesis has never changed. We pass on more deals simply because the valuations don't work. But we could also take that audience and build other things and experiences to it.
And so have you found that the model railroad portion is a harder audience to monetize compared to the aviation or the boating, or are they all
you mean non-direct monetization or what? It has a different, it's certainly, you're not going to sell railroad trains to the audience. It's a lower demographic in terms of socioeconomic. Like if you think about like the net worth of the audience is less. But as part of Comeback, we got an e-commerce business out of a book business. We bought a large railroad museum that we're going to build out, which was the largest indoor model railroad in the country or in the world. And it's a miniature deal. We bought it last December of 24. And we're now under the way of building out a museum in Tennessee that will be an experience. Think of it as like Disney World for model railroad or transportation nerds. And so it is a different sort of use case. Actually, the most difficult from a commerce standpoint has been our boating world. Simply because I don't think we figured out what to sell those audiences. We looked at finance. We in fact, AIM had invested in a marine finance business. But a lot of it was based on the personality of the founder. It was a joint venture, and we just weren't convinced that would work for us. And so we haven't figured it out yet from a commerce standpoint. We've done some e-commerce stuff, but it's not very big. But we still think these theses work long term. The nice thing is once you own the asset, you're not required to do anything immediately.
Well, especially if you trim the costs if you're not
You want them
making money.
to make money.
Right.
And really, because we've grown the media business so extensively, so quickly, a lot of our attention hasn't been on commerce. So much of it has been on unit economics, just trying to fix a lot of the business debt. I'm not talking like physical debt of like financial debt, but like business debt. Like people talk about tech debt. Businesses also have debt. They have a management negligence that there may be reasons for that. Maybe the business was a part of a much bigger company and they didn't need resources, or maybe this asset had sort of, due to underinvestment, had a lot of issues with it, or for various reasons. That tends to be the thing that has taken the most time, and frankly is the most challenging, because you're having to fix issues that you may not understand. And there's so much risk that goes into it because you're trying to decide. I think there's a lot of apprehension that goes into it because you're having to break the business initially. You're having to be willing to break it and say, we can shut down some titles, or we can reform the sales process or change commission structures or whatever. And you have to be willing to do that to fix the businesses because they're not going to work long term if you don't. And so that's what we've been doing all of 25. Second half of 25.
Right.
We planned on doing the first half, but we sucked at that.
Well, you probably read the same article we all read, Founders Mode, and jumped in
Well, I was running managerial mode for the first 2 quarters of the year, first half of the year, and I had to be founder mode. Yeah. I had to get in there and get my hands dirty.
All right, so you've got aviation, marine, you've got railroad, hobby now with some railroads, you've got the B2B, which we're going to talk a little bit about the B2B business, but as you look at sort of the landscape of verticals out there, are there other like major verticals you could see that this thesis works in? And are there some that it doesn't work in?
It's a great question. I think ultimately, in what we're buying is, are you familiar with the Lindy effect?
No.
It should drive so much of media thoughts. And so it's actually something that's been around. It was written by an author. The author escapes me. Somebody here should Google this. The Lindy effect is basically this concept that if something non-organic, not alive, but if something's been around for a long time, then it will be around for much longer. And it's really this. It's apparently a deli in New York called the Lindy Deli. It's been around for like 200 years or something. Wow. And it's going to continue to be around 200 more years, is the thesis. Is that if something has survived, think about magazines, or in the magazines we're buying magazines that have been around in some cases 100 plus years.
Right. They survived print, radio, TV, internet, AI, and they're still here.
It's survived not only the technology evolutions and business evolutions and consumer evolutions, but it also survived multiple world wars. multiple depressions, multiple pandemics. And the thesis is that if these things, magazines, still have subscribers that are paying and advertisers that are paying, then the chances are that these businesses, regardless of how broken the media ecosystem is, will still be around. And so these things still have value because they've proven the resilience through all of these periods of history. And that's been the thesis that's been driving the decision. So when we look at a media business, the reason we like print so much, which most people hate it, and most private equity, and look, I hate it too. From a business model standpoint, it is a really broken business. And like now that we have something like 40 or 50 brands that are print, that are actually publishing, I've learned how much I hate the business model of print because it's a very challenging business model that's really, a lot of it's just because this stuff gets built up over time. The business operated with one set of rules 40 years ago, but then now is forced to play in a much different world. And the business models have not caught up to that. The business is still like the content is still strong. The audience still love the brands. And so those are likely to survive. The business models need to change. And so what we're having to do is fix the business models of these businesses, not have to go fix the content or have to fix the brand. That's where the real value is. But you have to fix the business models. And I actually think that's where the arbitrage is. I mean, look, this is true even, you're a big X guy. This is sort of the joke about HVACs, the home heating. Anyone who owns a home knows what an HVAC is. But this is the heating and air conditioning roll-ups that you see, or the plumbing roll-ups that you see private equity companies do, is they're rolling up businesses that are usually small and their business models are somewhat broken. And they're scaling, they get the roll-up arbitrage, which is what you talked about, the valuation. As something gets bigger, it gets more attractive, companies will pay up premiums. There is certainly that. But then also they get the unit economic benefits of having fixed the business models that were somewhat broken. And you see this where private equity gets a bad rep, and deservedly so in some cases. But also what private equity does is it applies a financial metric and then tries to streamline the business, help it grow, help it manage the unit economics that oftentimes operators aren't very good at. And oftentimes our operators are taking the brunt of the poor business management and over servicing their clients. Not that that's bad. It's just you can't scale a business like that. And oftentimes these businesses don't survive when the market changes. And so we're having to do a lot of that stuff in the business. But our thesis is still the same, is these audiences have an enormous amount of value and can be monetized through a lot of different ways. We are buying businesses that are traditionally print because we believe fundamentally that print has something of value. It's a fundamental value. There's been a lot of M&A over the last decade of buying print businesses and fully digitizing them. And I've looked at a lot of those businesses that have gone down that road, private equity sponsored. And what I think is really challenging about that is, what are you actually buying? You're buying a digital website that's only, and a lot of it, they've gone full in on programmatic. Mm-hmm. Then it's like, they don't even have direct salespeople. Okay, well, I'm not really buying a revenue stream. I'm buying a programmatic asset. And then sometimes they didn't even keep the content people. They don't have subscriptions. So you don't know how strong that audience is. And so those are very different. That's not our model. Our model is to keep the print as much as we can, but continue to invest in the content side of it, but use more modern tools to help improve the unit economics.
So you're now pretty much vertical agnostic, and
much more so than I ever been.
Than you have been. So really what the thesis now is, if it's been around for a while, it's not burning a ton of cash, but it might be profitable or hopefully a little. You
want it to be something. Well, correct. At some point, we have to believe that we can make it. Like, we won't buy a business that's burning a lot of cash for sure. But there are plenty of situations that we've bought businesses that are marginally profitable to slightly less than under the existing ownership.
Because you believe that you can go in and make it far more profitable.
Because we can fix it.
Right.
But the reality is we can't pay premiums for what we're going to do. That isn't true in all cases. We will certainly pay more than the market, what they would get otherwise from, say, a professional financial advisor, because we are a financial sponsor, because we believe that we can fix on the unit economics. Sometimes that's true. Sometimes we overpay. But regardless, we're able to figure it out. But it is true that we are buying assets on a more agnostic basis.
And when you buy these assets, do you have like an expected post synergy EBITDA margin or something in your mind that makes you go, this will be worth buying this because I know I can get it to X in a year? Like how are you modeling that out?
Yeah, so we have a return. We basically have a hurdle. So our hurdle when we typically are looking at a business is a 4x, like a 25x hurdle is what we're underwriting it as. We've taken deals that we've taken at a 20%. When I say 20, not 25x, but
that's a big hurdle.
But 25% or 20%. We've done some deals that are as low as 20%, but typically, and so that's a 5. You're basically like at a 5-year payback. Is sort of the lower end of the market, but you have to believe that the synergies are worth it because your risk is that you're wrong, and so we always look at it and say we think this business could deteriorate 20%. We always put in a 20% discount of current revenue is going to deteriorate. Like if we're so wrong, we're going to be off by 20%, and that's been true. Not that we've seen it fall that much, but we've not.
Well,
seen
you
it
did
fall
with the boating assets.
The boating assets did. They actually only fell, I think. AIM fell like 11%. I think Bonnier was down 13%. But we knew 20% was where we headed. But we're comfortable. So we want to underwrite a 20%, but we want to get it, our 20% deterioration revenue, but we want at least a 5x. That's the upper end of the band. If the business has more warts to it and more problems to it, then obviously your risk reward increases. So you're paying less because you're wanting to underwrite a higher deal. So we typically are underwriting on a say to 3 to 5x multiple,
EBITDA multiple,
on their trailing numbers, and then we're looking for synergies within a year. It's a year before you can actually sort of declare victory on your changes.
And are those synergies just cost savings, or do you see like, okay, we're going to roll this brand into this portfolio, that sales team's now going to sell this, we're going to be able to sell across the entire portfolio because of this? Like how do you think about it?
I would love to say yes, that's where we'll be. But if for better or worse, we've ran these assets up until this year, we hadn't shut down any of them. We ran them as independent assets. But at some point you have to decide you're not going to invest in these underperforming assets. Like it just isn't worth it.
Right.
When you have 50 of them, you can afford. We cut 7 brands down this year, but really what it comes down to is we want to see significant contribution increases from those brands. And so, as an example, just to put numbers, is while we've paid, I think our average is like 4.1 times EBITDA at close. And if you look at the brands, this doesn't include corporate overheads. This is a little bit, but from a contribution standpoint, we're down to about 1.9.
Oh wow!
Now, in fairness, that doesn't include all the corporate overhead that it takes to manage them. But if you look at it, now that we've built out a scaled overhead, we're now in a situation where we get a significant benefits as we bring on brands without having to add corporate head. And so here's the interesting thing is we bought in 2024, we bought Comeback, which was 11 or 12 million in revenue. I can't remember the exact number. We bought AIM, which was, I think, 13 million in revenue. And so just in 2024, we bought $25 million of revenue. My labor expense now is lower today. Now, this was after the second half of the year. It's lower today than it was before we did the Comeback acquisition. So we did the Comeback acquisition in April of 2024. So I've added $25 million of revenue without any additional labor cost, or now my run rate is lower than that. So that's where synergies really start to add up. And part of it is when we bought Bonnier, we didn't have a built out print team. Like we had a very small print team, audience team. We weren't really good at print. Even when you had one brand, it was easy,
right?
Because you're doing everything. But then when you start to add, I think at this point we had like 6 or 7 brands, and then we bought Bonnier. We're able to bring in some of the synergies there. And then we bought FreightWaves, which brought us 62 employees. They're all digital native. And a lot of the management team that now makes up Firecrown came from FreightWaves. And so that helped us build it, but we absorbed a lot of costs with that. And then we bought Comeback, it was another 60 employees. And then we bought AIM, and it was like 45 employees. And so when you look at all of that, US employees, if you look at US, I'm only using US numbers because we have a business we bought in the UK, and they're not on their normal payroll, so I think they have like 30 employees, but I don't know the exact count.
You might want to know that they are still cost to you.
They're a cost. Now, I see the P&L. I just don't know the exact count because I don't see the actual numbers.
Right.
I get a consolidated financial statement, and that UK business continues to perform. I don't know the exact number, but it's like 30 employees over there. But total, if you look at US employees, when we bought these portfolios before close, it's 249 employees. We're down to 161 US employees. So we've been able to cut about 90 US employees from these different businesses that we've bought. And a lot of that's just synergies from bringing it on. But so we've built out this infrastructure now that we can absorb other print magazines without having to add. Like I didn't even have, before I bought Comeback, we didn't have like a consumer marketing team to go audience development. We had one dude who had spent all of his time in digital marketing and audience development. And he didn't understand the first thing about print. And frankly, we didn't either. Like we got really lucky with flying because we focused on audience development and a lot of them are very digital native. And so we were very successful with flying of doing audience development using the internet to do it. But when we weren't very good at that with all the other brands, we learned that pretty quickly with Bonnier, how bad we were at it. And everything started to tank all at once. In fact, if you go back to early 24, our aviation portfolio had gone from doing like $300,000 in audience subscriptions a month of new bookings to like, I think in February of 24, I got to like 40,000. And I was like, we're in trouble. And so one of the things that we found from Comeback is they had this very robust audience development team. You've talked to Nicole, done a podcast, very good at running that. And so we were very fortunate. And so we said, hey, go fix all of our problems. Please rescue us from our own problems. And she did. And her team has done great. So we got this world-class audience development team when we bought Comeback. With Bonnier, we got a world-class sales and advertising marketing team because they had very good sales and marketing. With FreightWaves, we got digital native assets and a team. And so we sort of bolted all these businesses on and have gotten synergies out of each of them. And now what we have is a very well-rounded team to do more acquisitions now that we've consolidated. And we've built some of our own systems in-house, which I'm really proud of. We've used AI to build some of these language learning models, have built some of our own tech, and we're really happy with where we're at. But like, it's, a lot of these lessons have been expensive, both time, effort, and energy and hair. Like
you didn't have hair, man. You didn't have hair before this.
I had probably had
you had like 5 right here, maybe 5 hairs.
Yeah, something. I've lost. Certainly, if I had hair, I would have lost it. Other parts of my body, Jake. Like,
crypto took all my hair away.
Well, I don't have a beard like you, but it has been. 25 was a brutal year for me. The first half was. And it really wasn't until October, November of, last 3 or 4 months before I finally have felt like, okay, now we're back in it. And I've had to have a lot of, call it business therapy from other founders and other people that I know who I've like you're just like burnt and you're like, I don't know what. I remember it was May of this past year. And I remember it was a Saturday. It was a beautiful Saturday, and I like to go fly when it's beautiful. And I didn't leave the couch for 8 hours. I was just physically and emotionally burnt because I'm like, I am so screwed. Like, because we had not executed. I, at that point, hadn't decided I was going to go just clean house, like in terms of fixing my problems and take a much more assertive role. I just remember sitting on the couch on a Saturday and I didn't move because I was just so like, I have screwed this up so royally. And I think founders do that. Founders do it. And then you wake up the next day. My wife goes, you need to go fly. It was a Sunday. So that was Saturday and Sunday. You could just go in the air. I wasn't sure if she wanted to, because aviation's a high risk activity. Usually she tries to talk me out of it.
Right.
But I was like, maybe she really wants me. Like, it's a great way to get rid of her husband, right?
And then she could run all the assets.
Yeah, exactly.
She could own it. She's probably.
But at least I knew that she wouldn't want all the debt that I had incorporated or the problems that I had taken on. So she needed me to live long enough. But I did go flying, and I spent 3 or 4 hours just flying around. Be like, okay, I'm going to show up the next day, and I'm going to fix this. And so that's what founders do. And like startups are very similar to roll-ups in the sense that you're rolling up. The difference is roll-ups is while you're inheriting, or not inheriting, you're buying a lot of the business and the cash flow and the customers. The problems are there with a startup, an early stage startup. you kind of see the problems building
Mhm.
because you're the one who caused it.
You're also the biggest problem yourself.
You
like
are
I
the
am my
biggest.
biggest problem every day.
Exactly. And that's just the way it goes. And like Mark Zuckerberg has this great statement and says, I think Peter Thiel had told him this years ago, where your business is going to suck, but as founder, you get to decide where it sucks.
Mhm.
When you're doing acquisitions, you don't get to decide those things. You're buying other people's suckery,
Yep.
combine it with your own suckery. And what I think is interesting, I've gone to this deep role of trying to understand acquisitions, these very successful acquisition playbooks. And what I find is that they run a playbook for the acquisition. And I think what has happened with us is we didn't have a playbook. We were opportunistic, but we didn't have a system for buying businesses and integrating them. We saw the cash flows and the revenues and the audiences and said, oh, that would be easy. And we let these businesses run on their own. And that creates a lot of cultural problems and resentment, frankly, from the people because they know you're screwing up, but they're also, so they see how screwed up your business is, but then they also know that their business is screwed up. So none of their problems are being fixed, but then you've added a lot more problems. And so now we have a much stronger thesis about being much more tactical when we go into a business and using our playbook versus trying to adapt them. And I think that should be a much more, it should have a much more exacting outcome.
All right. So I want to now spend a little time talking about your B2B business. So you bought FreightWaves sort of from yourself because you're the founder and CEO of FreightWaves. You then have Sonar, which was your data business or is your data business. You then split the business and bought the media asset from corporate. Right.
Yeah.
All right. So when you and I first did the podcast, you talked about how FreightWaves and Sonar worked really nicely together and they should be together because of negative CACs and the audience, you're basically promoting your data product in all of your stories, which you're making money on those stories while also driving to your data business. And you said that at the time, your investors were bought into this whole, it was a full ecosystem play. Then they're no longer bought in. Talk about what changed and does negative CACs not work anymore? Why is it that at some point they looked at this media component and said, you know what, Craig, your side hustle's media, buy this from this and keep us a pure play data business. What happened there?
The thesis still holds. And if this was a lifestyle business, if I were running Sonar, which is my data business, and FreightWaves, I would have kept them together. It's not a lifestyle business. It is a venture-backed, and venture is all tech investors. And you've written about this extensively, but a lot of VCs hate media businesses, no matter how good they are, because they're not venture assets. These businesses are rarely, although we've seen recent days that isn't always true. Rarely do these things ever trade at SaaS-like multiples. You rarely get an ARR multiple or a revenue multiple on these businesses. That most of it's EBITDA, and I think the exception to that is Semaphore, which is still $300 million for a $2 million EBITDA business. Just doesn't. That's a venture style investment.
Well, they still have to get acquired one day for that valuation.
That's true. So, and that's the other thing is you have, and anyone who understands the way this stuff works is that you have this pref stack that goes in, and that's basically, so effectively the way venture works is it's like a loan to the business. You have to pay back, and it's a dilutive loan. Debt, actually traditional debt, if you can cash flow, it's much cheaper than equity. But I'm not here to talk about financial metrics, but anyone who's interested should go down the chasm. And by the way, the founders don't end up with that money in most cases. So it goes into the business. But my board is a venture set of investors are looking for multiples of ARR outcomes. I mean, when they invested in FreightWaves, our last round was in 2021. I think we raised $16 million at a 270 pre or 286 post, $286 million. They're looking for a multiple of ARR on that business. And we've had offers, unsolicited offers in that range. And so they would have gotten their money back, but then some if they were earlier in the cycle. Some of the later investors, it might have been flat to them, so it wasn't desirable to them. But anyways, FreightWaves is, I like to say it's the Bloomberg of freight. And if Michael Bloomberg, in fact, much of our playbook has followed his playbook. If he were, what Bloomberg does in the financial economy, we aspire to do in the physical goods economy. And so we use freight is the market. And it's a highly volatile market. And so we have this high frequency data business, which provides companies that are buying and selling freight services, real-time pricing intelligence, as well as hedge funds that buy our data to understand sort of the goods economy and with data. And then you have this media business, very much like Bloomberg, which provides top of funnel for the terminal, or in our case, Sonar. And that media business then sells advertising, which subsidizes your production. The problem is the freight market collapsed. The longest downturn in freight history started in 2022. And it got worse in 23, and frankly, has gotten worse up until recently in 25. So, and early after 2023, our freight media business had detracted. I think revenue had contracted like 30%. And it had got to the point where it was basically break even. And we had suspected that it was going to deteriorate further because the freight market advertising is always the first to go. It doesn't matter how good your product is. And we still are the largest player in that space. In fact, our content, every metric you would care about if you cared about traffic or engagement is actually way up from where it was before. It's just that your customers don't have any more money to spend on advertising because they're just trying to fight for survival. Well, the choice that we had at our board level was, do we want to invest precious venture capital into a business that's not going to create a return, i.e. media, or do we want to invest that capital in our data business that should create a return? So you have precious finite resources. The other problem is that if you look at the buyer universe of who wants an intact media advertising business, business news business with a data business, they're actually very different buyers. Now, it is true that a Bloomberg or an S&P or people that are listening to this podcast potentially, a Dow Jones would want a media content and data business.
But private equity wouldn't.
Well, it's not even private equity. Think about the freight industry.
Mm-hmm.
There are 50 to 100 prospective buyers of our data business. None of them, not a single one of them, want to own a media business which covers the industry. Because if they write an article about one of their largest customers, you know how that works. Mm-hmm. That risks a $5 million software business or something, or a banking business. So our buyer universe opens up exponentially, and sponsors as well, private equity as well. It opens up a buyer universe. So I went to the board and said, look, our choices are this. We can go gut the media business. That's one option, which means significant rifts and reduction in cost and all this. Or we can keep it intact, but it means that we'll have to put capital into the media business to keep it alive. Or this third path, which is basically you can sell me the media business and all the assets and the people and resources that go along with it. I will keep it intact. But the reason I can do it profitably and that you can't inside this data business is I can take all of those resources, those 60 employees, and 40 of them can do other things. Like we can build digital scale across all these other assets. And that to the board felt like the best outcome because it preserved the value of FreightWaves as a media asset and the top of funnel benefit we get without having to put new money into it. And that was essentially, it was a financial engineering thing. And it turned out to be a really good decision for FreightWaves Inc. because revenue still has deteriorated in that business. It's not as if that 30% drop was where it ended. We're about half of what we were in revenue from where we were 4 years ago at the start of the freight recession. So, but we've been able to make it work and a net contribution to Firecrown because a lot of those resources have been deployed throughout doing other things. And so it worked out. This is an example. And the other thing is it is always reversible. So one of the features of that structure is in the event a Bloomberg comes knocking, which hopefully they will now that they hear this, or a Dow Jones or an S&P or somebody that's in financial markets says, hey, we really like this intact media business and data business, and we want them together. That is a reversible transaction. So what that means is that effectively you can put those businesses back together instantly, and a future buyer gets both the media business. Because the reality is, let's say that it is a Bloomberg or a Dow Jones. They already have media assets.
Right.
They don't need a platform.
Right.
And a lot of the cost that goes into managing a media business is a platform. And frankly, they probably don't want our platform anyways because they're going to migrate it to their own. And so this is set up for the data business is set up for a future buyer to bolt on either organically into maybe it's a freight and logistics software business that wants a data product. There's a lot of those. Like I said, the buyer unit is probably 50 to 100 companies. Or maybe it's a bank that services that space. But if it's a media buyer, a business media buyer, and they wanted the media, and we've got a lot of inbound from those companies, and a data business, it is very easy to attach that business back.
Well, so how does that work? If you as the individual owner of FreightWaves scale that business and then they claw it back, like how does that work from like a financial perspective? Like, is there a pre-approved multiple on the FreightWaves assets?
There is a structure to pull it back. So yes, that is conceptualized. I called it the Bloomberg option when we were doing the deal. And that was actually one of the things the board wanted to see is like venture boards are all about optionality.
Right.
Like the scenario of them significantly cutting FreightWaves was bad because there's downsides to that, right? The scenario of keeping it intact was also bad because it meant capital had to go into it. This was the least risky option for them because it meant that, and the Bloomberg option, one of the folks brought up, what if S&P or Bloomberg come in and want to buy it? Like they may want this. And so we set up a structure where essentially the company, FreightWaves Inc., can call it back at any time. Not call, but call. And there's a put call, not a put structure, but there's a call structure where, for those that don't know what the word call and put means, the financial markets terms, I know you do as a crypto guy, but effectively it means that the board of FreightWaves Inc. can basically say, we want it back. And the reason they would do that is very clearly if there was a buyer that demanded it back or wanted it back. Said, look, say, I'm going to use the term Bloomberg, said, hey, we really like this business and we really like the media business. We think it's an important piece, which if I were Bloomberg, I would believe that's the case. And I still think they should be together, frankly.
Yeah.
But if they decided they wanted that, all they have to do is they have to basically make it valuable enough to where it makes sense for the board to do it. Because the alternative is you wouldn't do it. And so it is no different than that. It is structured in a way that was very predictable and not punitive to the FreightWaves Inc. investors. In fact, they got a very favorable transaction because all negotiated on the front end. And frankly, who ends up quote unquote losing in that would be Firecrown would lose the FreightWaves media business and not get a lot of compensation for it.
Right.
But in the interim, what we got out of it is a world-class digital team and a digital infrastructure that is able to apply resources to these print brands. And now it would be much easier because that infrastructure has sort of filtered out through these assets. So look, I've had conversations with prospective buyers for our Sonar business, and I've said, you should call the media business. Like I even though it is favorable to me in the current structure, it is still a situation that if I'm a buyer, I'd want those together. But the buyer universe of an intact media and data business is actually quite small. The buyer universe of a data-only business is very large.
And so the likely outcome is it's a pure play data.
That is my guess, is where it ends up. Even you see this in business media, where companies that were traditionally business media, Hanley Wood's probably the most, now it's called starts with
Fusible. No.
That was Fusible as an example of that. Zonda.
Zonda, yeah.
So Zonda did this where it was a traditional print media business that decided to go full on in data and it effectively has shelved or shut down traditional assets. You talked about Randall Riley is a business that had both media as well as data, and they split the businesses to do it. And so this isn't actually uncommon in media circles because there's a certain finite number. And Informa in many ways could be described as this, is they went out and bought these businesses and they really just wanted the events business. And so they started to shelve or package up assets that weren't there. And so you actually see this common in media circles where a company was a publisher that ended up building a much more valuable business. S&P was McGraw-Hill. McGraw-Hill has gotten either shelved a lot of its print assets or sold them off. It is now probably one of the most successful pure play data businesses in the world, if not the most successful. But it started out as a print. Fast Markets is another example. If you go to Fast Markets in the 2015, 2016, it was a print publisher
Right.
of a newsletter, and it merged. It created price reporting, and now is worth well over $1 billion. Opus, which was bought by Dow Jones, same example. So these publishers have a history of building more successful businesses that become the thing. Much more so. Even Reuters, Refinitiv is a great example of that. So it's not as if we've created a playbook for ourselves. We structured it in a way that I think works for our investors at FreightWaves Inc., but also works to keep these businesses benefiting greatly from one another, because you get the symbiotic top of funnel assets without all of the burden of having world-class digital infrastructure cost, because you have a relatively small business. I mean, FreightWaves Inc. revenue is not the biggest asset we own.
Right.
Like it's a part of that asset, but it is a in itself could not support the level of infrastructure that we have.
So let's talk for a minute about Sonar. You're now pure play data. You take all that venture money, you put that into Sonar. You're investing in technology, all of that. Theoretically, that business is growing, but you also raised at a time when valuations were very high.
Yep.
And from what I've seen, those valuations across data have come down.
Absolutely.
So what has happened to data business valuations over the last few years? And at the same time, how is Sonar growing into its valuation that it had when you raised originally?
Yeah, it's a great question. I mean, valuations have come down. A couple of things that are driving that. Data businesses valuations are coming down. I mean, you've seen it if you have public data. Factiva is a great example of this, where Factiva doesn't create a lot of its own data. It sort of, in some ways, indexes other people's data. A lot of public database. Those businesses are actually quite hard right now. Valuations are coming down for those businesses because of AI, where I can go on to ChatGPT or Grok and get to the same data sets, or I can vibe code over the weekend and create a Factiva-like business. But there's actually something else happening in data businesses. If you have proprietary data that is not accessible through public domain, those businesses actually become much more valuable in an AI world. And so, because ultimately people now can build, I mean, one of the biggest issues of running a data business is that you're only as good as of your buyers being able to do something with the data.
Right.
And oftentimes they don't have the systems internally, operating systems and workflow systems, to actually do something with the data. And this has always been our problem. We sell this pricing data, but if we're not integrated into their software platform, it isn't very good. Like, there's only so much you can do on a screen, right? And so what we've seen is this bifurcation of data businesses that have become incredibly valuable in the AI world if the data is proprietary. If the data is not proprietary and it's public domain ready, that just destroys the value. So there is a bifurcation happening in valuation. We have a business that has highly proprietary data. 92% of the data points. We post 4.5 million data points a day. There was a CEO of another very successful data company, much bigger than mine, worth a lot more than mine. And he was very proud of the fact that they create 50,000 time series data points that he publishes. And he thought this was the greatest stat. No, I won't name the CEO because they may end up buying Sonar sometime. And I don't want them to be mad at me for saying this. He's very proud of this fact, how difficult that was. And then they asked about how many data points we do. I said, we do 4.5 million a day. And because freight is much more fragmented, a lot more granularity into it than what they deal with. Their commodity markets are much more defined than what ours are. And it's interesting because that is a real skill to be able to produce that many data sets.
But how are you getting that proprietary data?
Because we've gone out to the companies years ago and went to the platforms that connect. Like, there's a bunch of software companies in logistics. There's a bunch of payments companies and banks and services that are in our space. That because of the fragmented nature, there's 10 million companies that are in logistics in the United States, either buyers or sellers of transportation services. In trucking alone, there's 600,000 of these businesses. And so we went out to the software vendors and collected the data, bought the data essentially.
So you have a licensing agreement where they pass you
exclusive licensing agreement. And a lot of times I remember the first data set we did, the company, which was a large player, they're like, you want exhaust data? We delete that off our systems every day because it was our customers' exhaust data. It was all fragmented, non-specific, anonymized data that was just left over. It was the backwash. It was if anyone knows about oil refining, it's the diesel fuel
Right.
of or nat gas of freight data. In other words, it's the crap that's left over that isn't in itself very valuable. But we knew that if you want to understand a market-wide deal, the exhaust data is actually the most valuable piece of data, not the individual granularity. And so we went out and did deals where we were able to get exclusives with those providers, those software providers. And, we 100 some odd different deals later, we were able to get it. And then we have a good to good model, which is companies that are in the space that want to get more granularity, will provide us their data in return for some deeper data insights that they get out of that. So we can take their data, train a model with their data, but also give them back answers that they wouldn't get organically. And that's what drives the success of our business is that highly proprietary data. And that's what, and you're asking about valuations, that's where we think the business goes. And you've seen, even in recent years, so SaaS valuations have come down, largely because of the AI coding revolution. Non-differentiated data set prices have also come down. But you know what prices aren't going down? If you look at data deals, Lloyd's List, Opus, and some of this is, we're going back a couple of years ago. Frequent, there was a data business not too long ago that S&P bought, name escapes me. But these are data sets that, these are businesses that have highly proprietary specialized data. Those valuations aren't going down. In fact, they trade at higher than SaaS multiples. If you look at the growth rates, of like an Opus, this is 4 or 5% year over year and was trading at greater than SaaS-like multiples. Lloyd's List is the same example. Lloyd's List, I think, is sold at 9 times ARR for a business growing at 5 to 6 times a year. Like, these are really low growth businesses. And even the one that we're talking about, Fusible and Rand O'Reilly, what I was told is they had an offer for well over $1 billion that ended up falling up. They passed on it, but they bought a business from Informa. Gosh, I think that business was $25 million in revenue, but now makes up growing at like 3% a year, but now makes up the predominance of the value. It was this equipment database data set. And so having unique data, these data businesses will sell at very high multiples. And so we believe the best outcome for us is to sell to a financial markets data business, because those are the firms that will put the highest value because they can create derivative products out of it. We don't think we'll get the highest value. And we've had a number of unsolicited offers, but those offers have come mostly from logistics, software, or businesses that will not match what you see in financial markets.
So financial markets is probably the highest payer.
That is the end game for us. The problem that we have right now is we're too small for those companies.
Right.
So if you're a Dow Jones or a Bloomberg, as a business, as a data business, we're not big enough to be. Because what we do is nuanced enough from what they do in their core business that they would have to retain us as an intact business. It's not like buying like if we were doing energy price reporting or something. So we're doing energy price reporting. They could bolt us into Opus, or if you're Bloomberg, you could bolt us into.
Oh, you're a brand new portfolio company.
Yeah,
if you will.
It's just a new data set. Boom, you get all the synergy of that. The problem that we have, the challenge we have for that, is that what we do is so different. Like, there is no freight desk at Bloomberg or freight desk at S&P. They have the maritime and trade business, which is quite different than the trucking business. But there's not someone they could put us into. So we have to be big enough to be a division.
So what is Sonar's revenue right now?
I want to be careful pointing that, because we're predominantly, the reason I'm hedging there is because we are much closer to an exit today than we've been the last few times we talked, because just the cycle of when we raise money. And so I want to make sure that the number I put out is something that if someone's doing diligence in the future, I haven't shot myself in the foot by giving you a time.
Let me ask a different way then. For a larger company that would make you its own division rather than bolting you on, what would Sonar have to get to from a revenue perspective?
I think 50 to 100 million of ARR would be more appropriate for us, and we're not there yet. So,
all right. Well, I hope you get there.
I mean, look, I think it's we are certainly seeing the fastest growing parts of our business is in hedge funds and financial services. The slowest growing part of our business, the most challenged part of our business, is the logistics services. Frankly, because when the industry is in a recession, the companies that are buying that data are just trying to fight for survival.
All right. So you have talked about your goal by 2030 is to hit $1 billion in revenue for Firecrown.
And Firecrown, by the way, is not near an exit, so I can take whatever number I want.
All right. So what is Firecrown's revenue right now?
So we are today around 60 million, rounded, if you will.
All right. So 60 million in revenue, margin of?
Today, run rate, and this is after all of the cuts that we did, it's around 18% is where we would be today on a run rate basis.
Is that a good stable place that you want to play, or do you think you can get better?
I think we should get to 30%.
You think you can get to 30?
Eventually. We're not there yet. And I think next year our goal is to do about 20%. Because again, these are run rate basis. I want to be very careful what I say is 18% is after we made all these cuts. So we weren't there.
That's okay.
Half of the year. But now we're about 18%. And I think we can end up next year a little bit above 20. But I do think there's a path to get to 30, but a lot of it is just improving the unit economics of the business. And a lot of it isn't, everyone talks about AI as if it's replacing the editorial, because that's where most of the pressure is, right? I actually don't think that's where the opportunity is. I think the opportunity of automation software is in the back office.
Yep.
Like if you think about in a media business, the only two things that provide value for a media business is the content side and the salespeople selling ads.
Yep.
That's it. Everything else is overhead. So how many humans does it take to acquire subscribers? How many humans does it take to acquire, to put the magazine together? And you would be shocked. Anyone who's in print publishing knows that it takes a lot of humans, a lot more than it should. That's why these businesses are pretty inefficient. And so what we're looking at is how do we create efficiencies of using some of these modern tools to get it's fewer people per magazine, not content-wise, but operationally. And that's how you get the efficiencies. And that's why magazine businesses scale, and scale matters. And I've looked at probably, hundreds of deals over the last couple of years of magazines. And the thing that's consistent is you see a lot of owner-operated businesses where they just lack sufficient scale. So 2 million of revenue is really, that's the best case to pay yourself. Like you're getting $100,000 salary at 2 million because everything else is expensive. There may be a founder that's found a way to do most of the work himself and doesn't have that. But 2 million is sort of my threshold of when I start to see companies actually are actionable for us.
In print media.
On the low end, on print.
Yeah.
Digital is quite different.
Yeah.
The metrics are quite different. You can do it. You can have a great quality of life running a $500,000 media business if you're the only producer, if you're the only writer. You do all the work yourself. Maybe hire an assistant to help you or stuff. You just can't do that in print. And so it really is about a 2 million. My rule is like 2 million is the minimum revenue that I want to look at, unless there's a brand I really like, and then maybe we can stretch it. But 2 million is the low end. And then really, you don't start to get sort of that first stage of economies of scale until about 10. Top line. That's when but as you scale, you actually get quite a bit because your cost, if all of your incremental cost is in contributors and salespeople, then in terms of like the value added stuff in your business, then everything else is overhead. And so the way to really deal with the overhead problem is more scale. And what's great about some of the technologies that we've been building some of this tech ourselves, and will come, is that a lot of this tech can help you solve the human capital problem. And when I talk about heads, I'm not talking about necessarily cutting. I'm talking about I can grow more jobs into it. Mm-hmm. And so a lot of our team has been, our HR, we're looking at an acquisition that will take us to basically double the size of the employee count. And our head of and company we're looking at has a couple of HR people. And I asked our head of HR, how many people do you need? And she goes, none. She vibe coded an HR onboarding app that basically does all the work the administrative work of onboarding an employee. She built it using Replit. She just vibe coded it. She has no coding experience. And now she solved a problem. We used it we have all these contributors, and it was a disaster this year because we bought 20 different platforms and all of them had their own ways of paying contributors, own policies. Some pay it when they submit the article. Some Comback was prepaying for articles. Hey, we're going to pay you $100 to go write an article. And so different policies, and everyone had a different reporting structure. And so we had this flood of like 500 contributors that we're trying to pay each month, not actually knowing until after 45 days to close the month, actually how much our expenses were. And there was no budgeting process, none of this. All this is done in spreadsheets. It was a mess. And we were paying people slowly because we didn't even know like what we were owing. And
Right.
it was a disaster. And so our head of tech, we sat around a room and like, this is a crisis. We got to fix this problem. And it was in like late July, I think it was the last week of July. And we're like, let's go look, there's got to be some software to solve this. And we're in this meeting to talk about software. And I think we ended up evaluating some software packages. And we're in this meeting and he just starts getting on Replit and vibe coding. And within a week, he had this app that we use internally called Expense Flow, which is basically nothing more than a contributor management system that has all these approvals built into it, but it's designed exactly the way we want it to work. And it took him a week to build it. I mean, he had a prototype in out, like literally as we're talking about it, was all vibe code, but within a week we had it in production. It took about a month to get it all fixed and working. And now, I mean, we saved, the run rate in savings is about $1.8 million of cost that it saved us. And frankly, our contributors are much happier because they're getting paid on time. And so we couldn't have done that without that application. And so what I'm seeing now is businesses can use AI to solve the workflow problems, the human capital problems that come into all these businesses that have nothing to do with content. And so everybody talks about AI, and it's this very polarizing thing in media circles, rightfully so. But the power isn't in the content production side of it, in my opinion. The power is in all the other stuff, the operating systems that encompass all these technologies.
All right, so you'll make the businesses more efficient.
Far more efficient.
You're at $60 million in revenue right now, and you want to get to $1 billion in revenue in 4 years.
Yeah.
How do you...
That's not organic.
I understand,
but you can't do that organic.
So you're just going to be buying. You're going to have to buy $175 million, $200 million a year.
Well,
in revenue.
Remember, these things are. So let's talk about the. Effectively, it's a compounding issue. I'm not going to go buy a $200 million business today. But if you think about compound, we were a $9 million business in the end of 23. We're at $9 million. We're at $60 million today. So like, compounding happens because as you scale, and you'll see this in M&A roll-up businesses, is they don't, early on, they can't go buy a $50 million business. If you're a $10 million business, you can't go buy a 50. We bought I think a $13 million or $15 million business when we bought Bonnie or whatever that number was. Like we had to incrementally grow. And we grew 5x in that period of time or whatever the number is, 6x. And so now if we go buy, say, a $50 million business, in the next couple of months, then we're 100. And then you can start to level up. And we looked at a deal. We've looked at two deals. One was a $260 million revenue business that had, I won't mention the name, but it had some situational problems. And people who are in media circles probably could figure out it's one of three companies. And then we looked at another business that had about $160 million in media revenue that also had, it was a roll-up that had, the first one was not a roll-up, it was just a business that had some structural issues. Maybe it could be called a roll-up, but anyways. So we've looked at some of these larger portfolios where there was a thesis behind them, they rolled up a bunch of assets, and it didn't work out for whatever reason. A lot of it was because they bought into affiliate or digital marketing and programmatic, and that hasn't worked out. And so these assets are available. But there's 4,500 independent publishers around the country that produce magazines of some sort. A lot of them are really small. It would take a lot of work to acquire, $900 million worth of $1 million shops. You need to get these things in portfolios, and there are enough of those deals. I mean, you and I could sit here for the next 5 minutes and probably name companies that, and I'm not talking about the majors. I'm not talking about the Hearst or Condé Nast, but if we went to that sort of sub $50 million, I bet within the next 10 minutes, we could probably name off $4 to $5 billion of revenue when you start to accumulate them. So there's enough of these assets out there. The question comes back to financing. And so the limitation is ultimately, can we execute and can we finance it? And those are the only two things that really hold us back from growth, or hold, frankly, any business back from growth, is if we can execute getting these synergies and these unit economic savings, then can we finance it? And our financing structure is quite special, I would say. And look, I'm cheating. Like this is cheat code. We have a deal with our family office. My dad had a very successful trucking business, but my dad's a very shrewd businessman. And when I told him that I wanted him to invest, it was actually the Bonnier transaction was when he came in. Like I said, I got to $9 million without family money, and then I ended up inviting my dad into to invest in us. I pay him 15%, and he goes to the bank and borrows the money. He told me this past weekend that the bank just gave him a 4% interest rate. So he was paying 6%.
You were paying him 15.
paying him
He's
15%.
paying the bank 4.
And all he has to do is go sign a signature because he's got, he was highly liquid after his trucking transaction. So essentially the way it works is we pay him 15%. That's what we're paying him. He goes and borrows the money or uses his own balance sheet. However, he's really borrowing the money from me.
Yeah.
And I know exactly how it works, which is great. Like if I can get friendly capital, and the nice thing is it's patient capital because it's unlike, like there's a lot of private equity guys that are probably listening to this podcast and say, "Oh, I'll take 15%." The difference is that I know my dad.
Your dad's not going to like put you through bankruptcy.
He's not going to put you through bankruptcy. He's not going to declare foreclosure on the assets. He's not going to break my kneecaps.
Right.
Like he's 15%, make it 11.
He'll make you come over for another family dinner.
It's a loan shark style return. It's a private equity style return. It's an issued return. Like I am competing with him. I'm competing with other investments he could be making. But for him, it's a chance, and he gets to he is helping me run the business, and so I get a very successful CEO as a co-pilot. Even it's still my business. I like to joke he works for me, but ultimately it's the
until
old,
you pay the debt off, you work for him.
Exactly, it's the golden rule. Who has the gold rules? And so it's a very favorable outcome. And look, my dad's business was incredibly successful. So you got $1 billion family office behind the business that is only as limited to how much money how much liquidity we can take in. And we've set up a structure that works really well for him. And there's a lot of also just advantages from a tax standpoint, because you think about this from an estate planning standpoint. The highest return, but the most tax advantageous way that you can invest is to buy a cash flowing business for your family. And that becomes a part of estate planning. So it's a really great structure. It gives us a lot of flexibility. But man, when we're taking money on at 15%, it's brutal to do those capital calls.
You got to run
because
the business.
I'm I have to run a very responsible business, and I have to run a business because ultimately, we have to make a return. Like it's not as if this money's given to me. There's an expectation that there's a return. And so if we do capital calls, he makes it incredibly painful. Like I'm not asking daddy for $100 to go take a girl or go out for dinner. I'm asking for $1 million or $10 million. So we still have to operate the business the way any family office or any institutional investor would do it. The difference is it's flexible capital, and it's very long-term duration, because if we miss a quarter, like we missed the first 6 months of the year due to the problems I described early on, the advantages of that is that he's in the same meetings I'm in. In fact, he's like, yeah, I heard the same things that you were being told that your team was doing their job. I heard it along with you. By the way, that's a smart decision by me to bring him into it. Oh, yeah. So it's not the weekly meeting with your private equity sponsor, which I know many CEOs have had to deal with, where the guy's second guessing every decision. So this has been a very friendly structure, and it's one that gives us a lot of the ability to scale.
All right. So I could talk to you for another hour about this. We could dive into all sorts of different aspects of this, but I do want to end, because I actually don't believe in a 3-hour podcast. I don't know how people have time to listen to that sort of stuff. So I've got 2 quick questions for you. You are a founder multiple times over. You're now scaling this business. I am a founder. I am significantly smaller than you. For all the founders that are listening, what is some advice you'd give them to help them scale their business to a point where it's not a job anymore, but they're actually working on their company, not in their company?
Wow. I think your last point is probably the most salient, which is I think, and like everyone does this, I've done it. I think my management team did it this past year, is they work in the company, not on the company. And I think all too often and this is true even in management team. You say it throughout media. I look at the business we buy. I know media businesses, this is exactly true, where the business was built by a founder because he's got some unique perspective and was successful to be a media founder. And he loves the topic that he's covering, because that's how he built the business to be successful to begin with. He being she, whatever. The problem is that oftentimes those passionate founders are working in the business and not on the business. And I had certainly been, this is the case for me as well, where I don't take a step back and look at, am I really hitting my objectives? And I think oftentimes in media circles too, you get an ego element in it. You're like afraid of admitting your business has problems, and you're afraid. This holds back a lot of founders in any circle. And I think media is even exponentially worse because we all know how, like, we would cover, FreightWaves covers stories of companies that have financial issues or bankruptcies or whatever, and then you're kind of living in the same world. And you're like, man, this is like, I have a lot of empathies for these poor companies that we've covered. Because I'm now in the same situation. And I think the problem is that you have to sort of get outside of it and realize it. And this is what happened to me this past year is like, I realized that if I didn't fix my problems, that it was going to kill my business. I was never going to get out of this cycle of like mediocrity. And I finally woke up one day and said, the only way that I can fix this is to do the one thing I know to do, which is to focus on my cost, because that's the one thing I'm in control of. Like, back in the first half of the year, we had Liberation Day tariffs, which really hurt us, particularly from overseas manufacturers that were cutting ad spending on boats. We had just a lot of fundamental problems. Credit markets were weak. And our management team was letting that drive the decision base. They weren't,
Right.
They were too busy working in the business and not on the business versus saying, why don't we go fix the problems? But that took me waking up and getting some religion. And essentially, I did a podcast with my dad where he talked about building his company, US Express. And he bought a business from his dad, and the business was broken. And my grandfather had sold it, and the bank gave it back to him for $1 because they just, it was a $100 million business, but my grandfather had sold it to embezzled a bunch of money. He ended up serving prison time, by the way. But the bank was so underwater that they literally called my grandfather and said, "We'll give it back to you for $1. You get to work out the debt." But it was a prepackaged, they didn't go bankruptcy, but it was basically like, take it. It was insolvent. You got us here. My grandfather had the same management team and couldn't get it done. And he started to have health problems. My dad took over this business, and he did this podcast over the summer. And he's talking about how he woke up he'd been in this for 9 months and was like, I have made a massive mistake. And then he talks about how he just, over the course of a couple of months, there's a trucking business back in the 80s. My dad talks about how he just started firing all the management team, and he started to like fix the cash flow problems of the business. He's like, it wasn't until I made the changes that I needed to make before the business started to turn around. And I remember that I was interviewing my dad about his building this what became a $2.5 billion company, and about his experience of buying a business from his father and inheriting all of these business problems. And that was what, as soon as I got done with interviewing him, I'm like, I'm living out a problem that he also faced. Was these people had been doing this for decades and yet could not evolve their business to something that would be successful. They just weren't bought in. They weren't working on the business. And that has been the most important rule, I think, in business.
All right, last question. Of every topic, interest, whatever in this world, doesn't have to be professional, it can be personal. What is the one thing that has you most excited right now?
Gosh, I am a pretty excited person. First of all, I love freight. And people would not look at the freight business and say that this is a passion project, because for most people, it's a boring, dirty industry, right? But I think there's a project I'm working on. I'm going to tease a little bit, and once it becomes public, everybody will know what this was about. You'll be the first to break it. I think there's a chance to do a. You ever watch Yellowstone or Landman?
I love Landman.
Okay, so what Landman has done is pretty remarkable. Where Landman has taken this industry which has had no love, dirty industry, oil.
Mm-hmm.
In the 80s, it was glamorized through Dallas, but in recent years, it's become very frowned upon, right? Oil's this big, ugly industry. And they've made the story very interesting by creating a soap opera to it. And what they've done for the oil industry, is they've educated the public about how this industry works. Now, a lot of Hollywood exaggeration to it.
Sure.
But it's still fundamentally based on reality. And what it's done is it's elevated the consciousness. And I think there's an opportunity to do this in freight, to take a sort of a soap opera style Hollywood transcript. And in fact, Landman came from Texas Monthly. It was the Texas Monthly podcast. I don't know if you should do the story.
I should look into that.
It was a podcast done by Texas Monthly, and then Taylor Sheridan ended up buying the rights to it to create a TV show out of it. And so there is the opportunity to do the same thing in trucking or in freight circles of creating a consumer level media product, TV show, drama series that is backdrop in an industry and educate. And so there may be something coming out like that.
So does Brad Pitt play Craig Fuller?
we'll have to see what happens. But that is my that is something I'm particularly excited about.
All right. Well, Craig, thank you so much for coming to New York for this.
It.
And I look forward to seeing this show if it ever comes.
We'll see.
All right. Thanks, man.
Appreciate it.